Hey everyone, welcome back to the channel. Let's get straight into it. If you're new to investing, dividend growth investing might be one of the simplest ways to build your wealth long term. You buy high quality companies, they pay you out dividends, they grow those dividends, and you reinvest them long term. Very simple. In this video, I'm going to break down 3 rules I follow when it comes to someone who's trying to grow their money long term using dividend investing. Don't miss out. So, what exactly is dividend growth investing? Dividend growth investing is pretty simple. Instead of chasing the highest yield possible, you focus on companies that pay out a steady dividend, that grow that dividend consistently, and that have strong underlying businesses. So instead of chasing a 12% yield that might collapse, you might choose a 2 to 4% yield that grows every year. Over time, that growth compounds. So, rule number 1, don't chase yields. It's something I did early, and I definitely paid for it. A stock paying 10%, 12%, or more sounds amazing, but here's the problem. A high yield can sometimes mean the business is struggling, the dividend isn't sustainable, or the price dropped for a reason. Instead, I look at stocks or ETFs like SCHD or DGRO. These focus on quality companies with growing dividends, not just the highest yield possible. Now, I want to be fair here. Not every high yield investment is bad. There are ETFs that pay more than 10% that are structured differently and can still perform pretty well, but they come with more complexity and risk. For example, there's TSPY, JEPQ, and CHPY. Let's talk about each one real quick. So first up, we got JEPQ. This one has been around for a while. He uses covered calls on the NASDAQ to generate income. That's why its yield is often around 10 to 11%. It's more established, more widely held, and it's shown some stability compared to newer income ETFs, but it still sacrifices some upside in strong bull markets. Next, we got TSPY. TSPY typically pays around 13 to 14%. That's a really attractive yield, but a higher yield usually means more strategy risk, more volatility, and specifically with this ETF, there's less of a long-term track record because it's newer on the market. Could it continue to perform pretty well? Absolutely, it uses a great strategy, but it's not the same as owning broad dividend growth companies. And lastly, we got CHPY. Now, CHPY is an interesting one because it pays dividends on a weekly basis. That's really appealing for income-focused investors. And so far, it hasn't shown a heavy NAV erosion that some other weekly income ETFs have experienced. But again, it's still income-focused and strategy-driven. And by far, this is the riskiest ETF in comparison to the others mentioned. That means a higher potential for income, but definitely a higher potential for risk. Anyway, the point in all of this is that there are definitely exceptions to the don't chase yields rule that I just mentioned a moment ago, but they're not beginner-friendly holdings in most cases. See, we're talking about income-focused, strategy-based, and complex assets, and usually they're sometimes best suited as satellite positions. If they continue to perform well, that's great. They can offer some strong returns, but they require a really good understanding of what you're actually owning. Personally, I treat higher yield ETFs and assets like these as potential satellite positions, not the foundation of any portfolio. And to be honest, I think most beginners should stay away from stocks like TSPY, JEPQ, or CHPY because they're riskier assets. Now, that doesn't mean they're not going to perform well. It just means that they're riskier assets and may be a little bit more volatile in a beginner's portfolio. Personally, my core stays focused on quality and long-term growth assets. But all that said, income-focused strategies can be extremely powerful. Anyway, back to the original part of this video that we started with. Rule number 2 is reinvest and reinvest early. Compounding is the key here. If you reinvest your dividends, you're buying more shares. Those shares pay for more dividends, and those dividends buy more shares. It all snowballs. Most brokerages let you turn on DRIP, which stands for Dividend Reinvestment Plan. Some examples would be Fidelity, Robinhood, and E-Trade. Almost all of them do it. You don't have to manually reinvest every payment. It can all be done automatically for you. And finally, at rule number 3, try to focus on high-quality companies. You got to remember, your dividends are going to come from the profits in the companies that you're invested in. So I try to focus personally on companies that have strong revenue, consistent earnings, and durable business models. Now, some examples of companies that are often held in dividend ETFs are Coca-Cola, Johnson & Johnson, and Procter & Gamble. Now, if you notice, these aren't hype stocks. They're pretty boring, but boring can be powerful long term. So, if you like the idea of dividend income for your portfolio, there are 5 options you can consider that are, in my opinion, really good long-term holds and great for beginners. First up, we got SCHD, one of the most popular dividend ETFs for a reason. It focuses on high-quality U.S. dividend companies, strong balance sheets, and consistent dividend growth. It offers a healthy yield, strong screening process for the companies inside this ETF, and a very common core holding. Next up, we got DIVO. DIVO blends having dividend-paying blue-chip companies inside of its ETF and a covered call strategy for added income. This one typically offers a bit more of a higher yield than traditional dividend growth ETFs and is a monthly payer. At number 3, we got Realty Income, also known as the monthly dividend company. Now this one is a REIT, meaning that it owns income-producing real estate. This is also another one that pays monthly, and it has a long dividend history, but it's sensitive to interest rates and real estate cycles. At number 4, we got STAG Industrial, another REIT. This one's focused on industrial properties like warehouses and logistics facilities. It also benefits heavily from e-commerce growth, and it pays monthly as well. And last but certainly not least, at number 5, we got DGRO. This one focuses on companies that consistently grow their dividends over time. When it comes to the companies inside this ETF, it screens for dividend growth history, sustainable payout ratios, and good financial strength. This one's pretty similar to SCHD, and it emphasizes growth and quality. So all that said, here's what I've realized. Dividend growth investing, while it works, it isn't flashy, and it's not something that happens fast. It's slow, and it takes time. It takes time to compound. It takes time for the assets to snowball into the passive income streams that we hope will retire us from our jobs and all that stuff, right? This is about consistency, just like anything else when it comes to investing in a way that makes sense. So someone like myself who is trying to make their money grow long term, I don't want to come up with a lot of different strategies that require me to have to beat the market every week. That's a losing battle. Anyway, now that we finally got that out of the way, I hope that this video brought you some entertainment or some value. Please make sure to like, share, and subscribe for more content like this, and I'll catch you in the next video. Take care.